Welcome to Deezen Shira and Associates series of podcasts. My name is Cynthia. With me today is Angela, International Business Advisory Associate from Beijing office. Deezen Shira and Associates is a specialist foreign direct investment practice, providing corporate establishment, business advisory, tax advisory and compliance, accounting, payroll, due diligence and financial review services to multinationals investing in emerging Asia. Since its establishment in 1992, the firm has grown into one of Asia's most versatile full-service consultancies with operational offices across China, Hong Kong, India, Singapore, and Vietnam, in addition to alliances in Indonesia, Malaysia, Philippines, and Thailand, as well as liaison offices in Italy, Germany, and the United States.
Today we'll be talking about remitting service fees and royalties, how to repatriate cash out of China in the form of service fee.
Based on the relevant tax regulations, Chinese companies have to withhold tax on behalf of overseas company before any outward remittance could be made. There are several ways of repatriating cash out of China, and the tax implications would vary depending on the tax treaty between the recipient country and China and the form of repatriation. The WFI could remit funds out of China in the form of service fee by signing a service agreement with overseas company. The service fee would be subject to value-added tax and corporate income tax, depending on whether a permanent establishment is constituted or not. For example, based on the double tax treaty between the U.S. and China, a permanent establishment would deem to be constituted when a U.S. company dispatches employees to work in China for one project or related project for a period aggregating more than 6 months within any 12-month period. If a PE is constituted, the Chinese tax authorities often use a deemed profit rate, normally ranges from 15% to 50%, determined on a case-by-case basis to assess the taxable income. Once the PE is deemed to be constituted, it would be subject to 25% corporate income tax on its China-sourced income, as well as non-China-sourced income that has an actual connection to the permanent establishment. However, in the U.S. holding companies could claim the corporate income tax paid in China as a foreign tax credit in the U.S. to reduce the income tax burden in the U.S. Besides, all expatriates working for the PE would also be subject to China individual income tax on their China-sourced income from the first day they arrive in China for the duration of the PE project. Additionally, the service fee would be subject to 6% value-added tax and applicable surcharges.
Is the service fee deductible for CIT purpose?
Yes, service fees paid to overseas related parties are deductible for CIT purpose, provided that they are directly related to the WFI's business operations, determined based on the arm's length principle, and all applicable taxes have been properly withheld. This could lower the taxable income of the WFI.
What are tax implications of remitting royalty?
If the payment is made in relation to the use of intellectual property, such as patents, copyright, trademarks, and proprietary technology, it would be regarded as royalty and would therefore be subject to a 10% withholding tax before it could be repatriated to overseas. There would also be an additional 6% VAT and related surcharge. The remittance process of royalty is similar to remitting service fees, with the key difference that the royalty agreement has to be registered with the Trademark Bureau.
Can you explain the process of remitting service fees?
The State Administration of Foreign Exchange and State Administration of Taxation jointly issued an announcement in July 2013, under which the former tax clearance certificate requirement has been removed, and both individuals and institutions in China making outbound payments with an equivalent value of more than $50,000 are now only required to conduct record filing with the in-charge local tax bureau. The WFI, as the withholding agent, needs to register the contract with the in-charge tax bureau within 30 days of concluding the contract. The contract would then be assessed by the in-charge tax bureau, and the tax officer has the right to call into question the legitimacy of the service agreement and the cost of assessment. In this case, the taxpayer should be prepared to provide further evidence, including a detailed service agreement, to clarify the nature and location of the service provided and the relevant service descriptions as requested. The company could then apply for the treaty benefit if there is a double tax treaty available, which may take 15 to 20 working days. The following withholding tax filing and payment may take 2 to 3 working days, and the payment registration another 3 to 5 working days.
Thank you very much, Angela. Your insight on this topic is very valuable. Thank you for joining us today. For further insight into the regional economic environment in Asia, please visit our publishing subsidiary Asia Briefing at www.asiabriefing.com. Here you can find news, commentary, magazines, guides, multimedia, and more, which help guide the foreign investment in emerging Asia.